Welcome to the Daily Update, where I'll go over the action in the market for Thursday, January 11th, and then we'll see how things look for Friday, January 12th. Well, we had the CPI come out. Unfortunately, it's created more of a gray picture. Part of it kind of freaked the market out. Other parts the market seemed to like. We reacted initially before the market opened to the downside, and then by the time the market opened, we were to the upside. We gapped higher, went up to the all-time high, and then came all the way back down to the 20-period moving average. So we're kind of right in between right now, that all-time high and the 20-period moving averages, as the market figures out which way do we go from here. We're still positive with our technicals, but we're dealing with an overbought situation. We're also dealing with some potential areas of weakness that I'll go through and talk about in this video. So let's go back and talk about what happened. We did have a higher open, and prices rose up to R1 at 47.97. Then we fell back below the unchanged level, down below the daily pivot at 47.77, down below S1 at 47.63, and then we found support at S2 at 47.42. So on this basis, it was a pretty technical driven day. You could really see the pivot points coming into play. As the day went on, prices then rose back above S1 and the daily pivot, and we hit resistance at the unchanged level before closing slightly lower on the day. We were down 0.07%, almost unchanged, but it still counts as a negative day. On below average volume, we're still a little bit concerned about that. We're getting a little bit higher than we have been the last few days, but we're not really seeing a real surge in volume nonetheless. We are positive with our technicals. We're dealing with an overbought situation. The market is just kind of confused right now, and that's what the market likes. It likes when things are kind of gray, and it's to shake out the weaker hands and then to let the stronger hands come in and say, okay, we're going to take this thing higher, or we're going to take it lower. They're even trying to figure out what they want to do. And we have another important report coming out in Friday's session with the PPI. What's that going to tell about the whole inflation situation? We're also dealing with another potential escalation of a geopolitical event, which doesn't seem to be really having an impact on the market. I'm just keeping an eye on it for right now. Things are escalating over in the Red Sea as the US and Britain are ratcheting up some attacks against Yemen. And that's kind of resulting from what developed in Israel a few months back, and now it's kind of spreading to a wider region. So we want to keep an eye on that to see how things unfold there. Some comments that we can make. We did hit resistance with the S&P at the all-time high. Now, when you look at my charts, they're going to look a little bit different, and I'll explain that. I go with the all-time high being the intraday high, where they're basically looking at the closing high for that. So the charts look a little bit different. Mega caps and growth did outperform. So that's really what kept things in order in Thursday's session. Cleveland Fed president came out, who is a voter right now, and said that March is probably too early for a rate cut. Okay. Yeah, these folks like to talk. They like to, make their opinions known, maybe to cause a little bit of ruckus from time to time. The market was kind of heading in that direction anyway, as these economic reports are coming out, but that's more of an official statement. The SEC also announced yesterday that it's approved 11 spot Bitcoin ETFs. Spot just means what's the price right now. These aren't futures contracts. This is where is Bitcoin at from day to day. That's been in the making for quite a while now, and that was really propping up the whole cryptocurrency market. And then it kind of got put on the back shelf, and now that it's coming back out again, that's really helped out some of the cryptocurrencies in general, and Bitcoin more specifically. On a short-term basis, we still have our Williams %R and the stochastics that are extreme positive. We still have a pretty long list in the intermediate term with the 50-period moving average study, the rate of change going back 50 periods. Our oscillators, a lot of them are still extreme and coming down, and pretty much all of them now have dropped below their moving averages. The Sean Trend Meter, the bullish percent index for the S&P, as well as the NASDAQ 100, and our new high, new low study for the S&P. Long term, we're still looking extreme with our 150 and 200 period moving averages. The current scenario that's kind of been morphed a little bit after last week is that the Fed might be done raising rates and they're possibly going to cut rates in 2024. What the big question is now is when is that going to start? And they're still kind of holding out hope that it may happen in March. But after the statement that Fed President Mester said and some of the economic reports coming out, it doesn't look as likely. Another thing to keep in mind is if these economic reports come out stronger than expected, it wouldn't be beyond the Fed to come back in and actually raise rates. The dollar was up and interest rates were down. We've dropped below 4% with the 10-year yield. We're at 3.98%. We still are inverted with the yield curves that we've been watching now for a year and a half to 2 years. Sentiment, it's not extreme. I should have changed that. It's positive where we had been at 75. That's extreme positive. We ticked down to 72 after Thursday's session. That's still positive. And we're working off of using this as a contrarian indicator, or at least looking to see if that's going to develop. Our trend is still positive. The green line is still on top. We still have both ADX charts that are dropping below their moving averages. Right now, I'm keeping our bias at mixed because we had a pretty solid up day on Wednesday and then kind of a down day on Thursday. The market's really indecisive right now as to what the bias really is. And our momentum, I'm also keeping it mixed because we had been negative. It looks like we were shifting back over to positive, and now we're kind of right in between. The economic reports that came out, CPI came in at up 0.3%. They had expected 0.2%. That's the headline number. That's what caused the initial reaction from the market, and it sent the futures lower about an hour before the markets opened. Last time we had this report, it came in up 0.1%. The core CPI, and this ended up being good news. It came in at 0.3%. They expected it to be up 0.2%. Last time it was up 0.3%. So this was kind of a mixed report. The headline number was stronger than expected. The core reading is weaker than expected. Weekly jobless claims dropped off. They're at 202,000. They had expected 209,000. Last week we had 203,000. And then the continuing claims are also dropping at 1.834 million. Last week it was 1.868 million. And I have charts of all these to show you. Here is the CPI year over year, where the blue line is the total CPI. And that's starting to tick back up as we saw a bit of a rise there. And that caused some initial negative reaction. Where the core, that continues to decline. And that ended up giving some support after the initial gyration, and that's why we had the higher open. Then when we look at the CPI services, when you look at the services and you take out energy, they are declining. They're turning back up just slightly with the core commodities. Then here's our chart just showing the rate of change going back year over year. We're starting to tick back up on a year over year basis. It's also starting to go back up on a month over month basis. And then here's the core CPI, which is declining on a yearly basis and is still going up, but slightly flat when we look at the month over month basis. Here are the weekly jobless claims. They continue to drop off. This is suggesting economic strength. This is what the Fed is watching to see, okay, are we going to be justified in raising rates? If the employment situation is still really strong, we may not just forego cutting rates. We may end up having to raise rates at some point. And here are the continuing claims, which are also dropping off, which is suggesting some economic strength. Here's all of them together. The red line are the initial claims, which are declining. The blue line are the continuing claims. That's also declining. And then a week ago, we had unemployment come in at 3.7. That was unchanged. Here's some Isabel Net blog charts. I know some of you are interested in the small caps. It's really kind of out of my wheelhouse of what I do, but I keep an eye on the small caps, and they are still considered to be inexpensive or cheap. It says here, low current valuations and a healthy economic outlook signal solid small cap returns. That's if the January effect can even come back and start happening again. We do see a real thrust up with small caps, and then we see many days of give back right after that. And that's been what's really frustrating. And we're seeing that to a degree more with the mid caps as well. And then here's the Magnificent Seven. This is their market cap for the S&P. When we were hitting up at the top, they were 30% of the market capitalization. And that's why we keep an eye on those bigger stocks, because they have such an influence on the S&P itself. That's also why we compare it to the equal weight index to see if they're really diverging or converging with each other. Here's our intraday chart where we did gap higher. We got up to R1 just briefly. That set the high for the day. And then we started to come back down. We broke down through S1. Then we tried to bounce up off of that. We came down, actually broke below this 47.50 level, which seems to be important currently. And then we found pretty solid support right here at S2. Do you think these pivot points are important? And then this is encouraging. And so you could see the initial open and then things turn negative. It's like, oh boy, here we go. But then the later day buying that we saw coming back in, that suggests things are a little bit more positive. We were able to get back above S1, above the daily pivot. We actually went positive there briefly and then dropped back down below the daily pivot, only to close slightly lower on the day. Here's the intraday chart where the futures were kind of quiet in the initial overnight session. And then Europe was doing pretty good. And we saw the futures up about 0.25% there for a while. And then here's the gyration after CPI came out. We see the move down, then the move back up. And we're headed just a little bit lower in the initial overnight session. This is rather encouraging too. We are seeing where the blue line is above the red line. That means that growth is outperforming value. That's what we want to see some internal strength in the market. We're also seeing some improvement here with the S&P with our growth to value ratio. Over the last few days, this ratio has been going up, and that is encouraging. Then our end of day charts where growth was up, where value ended up being down, and the mid caps growth was up, where value was down, and small caps growth was down, but it was down quite a bit less than the small cap value. And we're seeing a little bit of an improvement here with our S&P growth to value ratio on the end of day chart. This is starting to go back up, but we did generate a recent death cross with this ratio. Looking at our trend, we are below the moving average. We're below 40. The green line's on top, even though it declined, but we still would default to positive with that. And pretty much that same thing with our short-term ADX chart. Volume still continues to be below average, and that's a bit of a concern, but it's kind of hard to read what's going on here because we see it below average on an up day, below average on a down day. A major economic report comes out, we still see below average volume. You've got a lot of apprehension right now. Keeping an eye on sentiment, we saw some weird things happen here. The Ulcer Index did turn down just a little bit. We also declined with the VIX, with the line chart as well as the bar chart, even though we spent a large part of the morning being negative. That's when you look at the bar chart, that's when the VIX was going up. And then as we were recovering with prices, the VIX started to go down. And we're also seeing it drop off with the VIX of the VIX, showing the volatility is really quite low for the VIX. And we're getting back down to some pretty extreme readings here, showing there's complacency based on this type of measurement. We did come back down with our correlation between the VIX and the S&P, where we spiked up above this line, and then we have now started to come back down, but we haven't seen all that big of a movement yet as far as the market is concerned. And this is where we're seeing some crazy things. I couldn't show the equity put call charts after Wednesday because they hadn't been updated. Well, and I had to double check this, and I even Googled this, and there's some stories, I think it's from NASDAQ.com, that were talking about this because I didn't know if this was erroneous data or what. But before the CPI came out, there was an awful lot of hedging going on, and that meant that if you're long something, long a stock or long an index, where you're going to buy some puts to protect that so that if things go against you, what you lose in what you own will be picked up in the puts that you own. And that's what we do with hedging. And there was an awful lot of that going on. There was a lot more puts being bought than calls, at least on a broader basis. And that sent this ratio really, really high. And now I don't have it with stockcharts.com, but they do have an equity put call ratio for the S&P. That really didn't move all that much. And I wish I had a chart of that, but they just don't include that. But when we look at our 5-period simple moving average, we've now spiked all the way back up to an extreme reading. If we do top out and start to come down, that could actually give some support for the market to go higher. And we also saw a decline with this fear gauge that we follow, as well as the other fear gauge that we follow. So Even though the morning time saw a lot of negative activity and a lot of selling, by the time everything closed, we actually switched over positive on a price basis. Now, internally, we're still seeing some warning signs. We did get the latest reading from the American Association of Individual Investors, and it really didn't change all that much. They're not necessarily extreme positive, but they are positive. And remember, this is a week ago, and a week ago, things were not looking all that good. So, the fact that they're still hanging in there with their optimism, you could take that as encouraging, and they're not necessarily extremely optimistic right now. So we kind of go with this in the meantime. And that's what this red line on here is for. It's to kind of show the general trend over a period of time until we get to an extreme reading. Then looking at the ratio between risk on and risk off, we did decline just a little bit. This is kind of concerning. We want to see this going up to be more positive for the market. It's actually, it came back up, but now it's just kind of chopped around the last few days. Looking at our advanced decline line based on price and volume, we actually showed a bit of a decline, especially on volume. We were pretty much flat based on price. And we did see some more new highs being generated, but not enough to really kick our 5 period into gear. And also notice that I haven't been pointing this out. This is a pretty extreme positive reading where we're at right now. And that might be some of the reason why that this is really having a difficult time turning back up. But our 10 period continues to decline overall. We're looking at the advanced decline ratio. We're at decline, but we're still above zero. Accumulation distribution, still hanging in there, still above the moving average. We might be a little bit concerned that it's getting kind of far away here, but the fact that it's going up is positive. But we're still seeing a little bit of trailing off here with the Chaikin money flow. So what we're seeing on the previous chart, the accumulation distribution, which tries to measure the smart money, the Chaikin money flow also tries to measure the smart money. We're seeing kind of a confusing picture right now. They're not really confirming each other. When we look at the NYSE cumulative advanced decline line, we were down. So the broader market was actually weaker, and we declined a little bit with our regular NYSE advanced decline line. We were down a bit with the common stock NYSE as well as the common stock for volume for the NYSE. We declined a little bit with this other NYSE advanced decline line. And the reason why I show these multiple advanced decline lines is they're all calculated in slightly different ways. So we might get some insight looking at these charts. There's other studies that we look at where we're declining with the common stock on the NYSE. We were flat with the S&P 500. We declined a little bit with the mid caps, and we're really underperforming with the small caps. And I'm basically looking at, okay, this previous high here for the mid caps and the small caps, we haven't been able to get back to that, where the S&P has been holding up much better. Looking at our daily chart. Now, this is where we see a little bit of a difference. This red, or not red, orange line that I have here, that's the intraday all-time high, not the closing all-time high. If you look at another chart, that was the high that we set, was the all-time high for the close. And we hit that resistance point and then started to come back down. On the volume, on the bottom, we did pick up with volume, but we're still below average. The wins percent are ticked down a little bit, but it's still extreme positive. And here are the recent scores. I go over these all the time. I'm just going to let you look at these instead of going through them. The 20-period exponential moving average is declining slightly. We're still extreme with the 50, and we're just kind of barely extreme to slightly not extreme with the 200. And this is where we found some support at the simple 20-day moving average. That's where the low was set. We set the high at the all-time high. And so that's the range that we saw in Thursday's session. Now we have to watch. Are we going to break out and set a new, at least on an intraday basis, an intraday high, all-time high? Then we worry about the close. Are we going to close at a new time high? The NASDAQ 100 and the Dow have set recent all-time highs. The S&P has not done that yet. That's what we're waiting to see will happen. And in the meantime, you can expect a fight. If you look at a longer-term chart of the S&P, there's an awful lot of stop orders right at the all-time high. There's a lot of people just waiting to get in at that level to short the market, especially when we're in an overbought condition. So there's going to be a real battle. It's going to take some real volume to push us through and get us higher. Or in the meantime, we may see some real resistance at that level. The Force Index still looking okay, just a little bit below the midpoint. The midpoint is showing a little bit of an improvement, but the force index is positive. And we're extreme, but turned down with the short-term stochastics. We're starting to get barely extreme in the intermediate short term. We're turning back up and just barely extreme positive in the long short term. And I like to explain this every once in a while. The short, intermediate, and long term, this is a further subdivision of the short term. All of these together are short-term indicators. This just gives us a bigger breakdown. We're still at the +2 channel with our standard deviations chart, so we're not extreme there. And we're dealing with the 20-period double and triple exponential moving average. We came right back up to it after Wednesday. Now we've dropped a little bit down below it after Thursday. Intermediate term, we're still hanging in there with the balance of power. We're above zero. We're still positive with the go, no-go system. We're still positive with our highest high value. We're seeing a little bit of an improvement here as the TTM squeeze is flattening out, but it's positive since it's blue, but it's kind of with negative connotation here because it's the dark blue. We want to see this turn back over to a light blue to be more positive. The ease of movement continues to be above zero in advance. That's positive. Where the Arun suddenly woke up and said, oh, something happened here, and it kicked back up, and we're now getting another possible extreme positive reading, or at least close to it right now. But when you look at the McClellan oscillator for the S&P, we're still below zero and declining. So you can see the real contradiction that we're seeing here. So when we look at the summation index based on price and volume, we continue to decline. And the NYSE McClellan oscillator also declined and is below zero. So the summation index for the NYSE is also declining based on price and volume. We're still above zero, though, with the Swenlin trading oscillator based on price and volume. See how we're getting mixed signals here? We're coming over and we're below the moving average with the PMO, but we're still extreme positive. But we are declining based on price and volume, and we're still seeing this longer negative divergence with the percent of PMOs that are rising. We're still seeing a negative divergence with the buy signals, and we're still extreme positive with the PMOs that are above zero. We still remain positive, though, with the Elder's Impulse system for the S&P. We've switched now for the second day to being positive for the S&P with the parabolic SAR system, but now we continue to decline with the slope oscillator, and the MACD is trying to turn up, but it's still below its moving average. So all of our different oscillators are below their moving averages, and still they're trying to show some improvement at some points, but they're still looking more negative after giving an extreme positive reading. And here's where we came right down to the simple moving average, the 20 period, and we were able to bounce up off of that. So for right now, short-term support is holding. And the bullish percent index, it's not really dropping, it's not really rising, it's ticking down just a little bit, but it's still above 70. We're also declining with the NYSE bullish percent index, and we turn back down with the NASDAQ 100 bullish percent index, and we're still extreme with the NASDAQ 100 and the S&P 500. We came back down, but we're still extreme with the Sean trend meter. We're still looking a little bit better with the Chaikin oscillator. The money flow is still above 50 and is now flat. The ultimate oscillator is above 50 and advancing. The vortex is still positive with the green line on top. The rate of change is coming down, but still extreme positive. The RSI turned down just a little bit based on 14 periods and is above 50. And we turned down just a little bit as well with the 9 period and also above 50. We're still positive with our on-balance volume, even though we're chopping around currently. And we're still positive here with our NYSE new highs minus the new lows. We still remain above zero, even though we ticked down a little bit. We're still coming off of an extreme reading with our 200-period moving average study, as well as our 50-period moving average study for the S&P. And then I haven't shown this in a while. This is where I wanted to bring out that if you look at this all-time high here, that's an intraday high. And that's why we didn't quite come back up to that in Thursday's session based on price. We did hit that intraday on a closing basis. And then I'll probably stop showing this now after this video. I'll probably show it either in the deep dive video or one of the other videos that I do. But we did start a new cycle on January 2nd. It looked like it was really going down. Then it looked like we were bouncing back up. Now the market is a little bit confused. And we came back down into this mini rainbow with our 20-period simple moving average of the open, high, low, close, and we were able to bounce up off of that and close back up out of the rainbow. So we're looking a little bit better here with the Heiken Ashi. That's turning positive. We're actually turning a little bit more positive with the Kegi. See, it's just barely black up here at the top. That's positive. But, oh, I shouldn't say but. And we're looking a little more positive with the Renko chart, and we're showing some improvement with the 3-line break. Some long-term charts, we are still extreme positive with the 150 and 200, even though we're rolling over slightly. We're still above this longer-term trend line, going back to the 1987 crash. We're still above, kind of right on the trend line with the NASDAQ 100 going back to 2009. The equal weight index did underperform the S&P, so when we look at the ratio, it ended up going up. That means the mega caps outperformed, and we're still seeing this longer negative divergence between the Dow, which is right near the all-time high, and the transports, which are lagging and haven't been able to get above this previous high. And we saw utilities really decline, which ended up giving some support to stocks. But the transports continue to underperform the Dow. The Dow is pretty much chopping sideways right now. It was up barely. The diamonds continue to be positive, though, with the Elder's Impulse system. And we're looking a little bit more healthy here with the NASDAQ, where we didn't come back down to this pivot point, even when we saw some weakness. We're seeing a series of higher highs in the most recent days. We're also seeing that same kind of thing with the NASDAQ 100. So this chart is looking a little more healthy. And we continue to be positive with the QQQs, with the Elder's Impulse system, but the momentum is negative. However, it is improving. The small caps, this has been kind of disappointing. We came right down to this 1260 level. That's where it found support, and we're still underneath this pivot point after generating a recent golden cross. And we switched from being neutral back over to negative for the Elder's Impulse system when looking at the small caps. We're still below this resistance level with the Russell 2000 small cap index. We're below 50 with the RSI. We're declining based on momentum, but we're positive when we look at the trend. The mid caps are still above this pivot point and looking a little stronger right now. They continue to be neutral, where the small caps have switched to negative with the Elder's Impulse system. And the FANG index is right near its all-time high. Didn't set a new one, at least yet, but it's getting close. The dollar is showing a bit of a rebound, but has been chopping pretty much so far in 2024. Keeping an eye on the 10-year yield, where it did decline. 10-year based on price did advance. Then updating our growth to value charts. Here's the Qs to the S&P, where we're showing some improvement here. We're kind of flat, but still under the moving average when we compare discretionary to the S&P. Large cap growth is showing some improvement when compared to large cap value. So with the large caps, mid caps, and a little bit to the small caps, we are seeing some improvement. We're still extreme positive. Well, at least I got through most of the video before I had to start clearing my throat. We're still extreme positive with the 10-day average of the S&P 500 highs minus the lows. We're still just barely above zero with our highs minus the lows, 5-period moving average, measuring across the broad market. We're coming back down just a little bit with our 50-period new highs, new lows study, but we're still well above zero. And we're coming down for the most part with the 2-year yield, which often supports the S&P. We're also starting to go back up after being really choppy with the S&P to utilities ratio. If this continues to go up, that could be positive for the S&P. And the Staples to S&P 500 ratio is declining. And the longer that declines, that's also positive for the S&P. So what's our outlook for Friday? Please be aware that the markets will be closed on Monday, January 15th for Martin Luther King. So the markets closed on that day. Banks will start reporting earnings on Friday. And that's kind of the traditional kickoff to earnings season. Then we're still asking this question. Is the January effect over? Well, we don't really know yet. Small caps were looking good. Now they're just kind of floundering around. Right now, we continue to be 0 for 2 with our trifecta. We'll find out the last score at the end of January. Our technicals are positive, but we're between the 20-period moving average to the downside and the all-time high to the upside. We're going to get PPI on Friday, and that could be rather influential, but CPI is usually the really big one. Keeping an eye on the geopolitical events, I've also added Yemen here to the list. We just want to keep an eye on that. And here's the calendar. I'll have the new calendar when I do the video for Tuesday's session. Seasonally, we tend to be neutral to negative across the board with the Dow, S&P, and NASDAQ. Here's a chart I found from Isabel Net blog charts where we tend to be choppy at the start of election years, and that's pretty much what we've been seeing so far. And we do see some positive seasonality on the 9th trading day, according to the Stock Traders Almanac. We're following the green dashed line for the S&P. We're wondering where we're at here with the January effect. Or is this little downward move? Is it going to continue to go up? Are we going to go sideways? We don't really know right now. And this kind of confirms the chart that we just saw, where we tend to be more sideways to choppy during an election year, at least at the start. And then later in the year is when things tend to improve. We also see that here with the Stock Traders Almanac, looking at the green dashed line. But when you have the current president running for re-election, which we think that's what's going to happen, at least, but there's a lot of other scenarios also being brought out with what could happen there. And that might be some of the reason we're not seeing this historical seasonal strength that we have seen in the past. We will be in Friday's session, which tends to be the second most positive day of the week. So our scenarios can't really go with the down one, especially as long as we stay above the 20-period moving averages. Now, if we drop and close below that level, our charts are going to turn more negative, and we may be able to adopt some kind of a negative scenario for next week. But right now, we really can't adopt that. So we're leaning more towards the upside because things are still looking fairly positive. We're just dealing with a pretty overbought situation. We're not going with the sideways scenario now because our ADX charts, even though the trend are weakening on both charts, we're still well above 20, and we would default to positive because the green line is on top for both charts. The warning signs, we're still wondering if growth is going to continue to improve. That would really help the market. It's been showing some improvement over the last few trading sessions. Will that continue? The risk on posture is showing some weakness. We're not seeing that really going up all that strong right now. The equity put call ratio, it's going up and is really extreme now because of what I talked about earlier. The transports are still continuing to negatively diverge from the Dow, and that's longer term. That's going to take some time to work out. And our 1 to 3 month short-term bond spread continues to be positive. I'm not sure why. It should be negative. The Copic curve is negative. Our oscillators are rolling over and below their moving averages after being extreme. I feel like a broken record saying this, but this is what we've been seeing now for the last week to week and a half. The momentum for the NASDAQ 100 continues to be negative, but it is improving. It's trying to turn back up, but it hasn't crossed its moving average. Sorry, I had a cat walk in here that I had to keep an eye on. The long-term daily special K chart is positive, so that's one of our positive signs. The longer-term equity put call ratio, yeah, it's going down, but with this really strong blip, it's actually turning up just a little bit. I'm going to wait another day to figure out what's happening there. The parabolic SAR chart is positive. The bullish percent index, it's positive, but it's weakening and it's starting to drop, but it has not dropped below 70. The vortex is positive, and the Zohar-Check method continues to be neutral. We still have a recent golden cross for the Russell, the small caps, and the mid caps. Small and mid cap growth, it's just chopping around sideways now, but continues to be positive for the most part. Financial sector, that's what's going to be interesting in Friday's session. The banks are going to be reporting. What's that going to do? We'll have to see if that gives the market some support. And then our longer-term 50-period new high, new low study continues to be positive. So our conclusion, we're positive, and we have to go with that because that's what our charts are suggesting. And we're right in between the 20-period moving average and the all-time high. That's what we're watching right now in the short term. We still continue to have a long list in the intermediate term of overbought indications. And we are overbought in the long term, but we also remain positive. So thank you. I hope you have a really good day, and I will talk to you in the next video.